Hello, everybody. What is going on in real estate for the month of June? It's hard to make up from down, really, depending on who you're listening to, what news you're watching. It's either the sky is falling or the property market's climbing. And in some ways, it's a bit of both. The sky is falling for some people, definitely. And also the property market is increasing. So depending on where you look, you're going to find the news that you want to see. Today I want to go through a bit of this and that. So I'll dive into some RBA data, CoreLogic data, and a little bit of anecdotal on-the-ground evidence. So strap in. Today's podcast or analysis is going to be a little longer than normal. Let's start with the RBA's announcement, which happened a couple of days ago. Good news, they have decided to hold the cash rate at 4.1%. You can breathe a little easier, but that's not to say that they won't continue to increase that cash rate. This report or this announcement basically goes on to say that inflation in Australia has passed its peak, with the monthly CPI indicator for May showing further decline. So look, it's declining, but inflation is still too high. It goes on to say that basically the jobs market, wages growth has picked up. The jobs market is still quite tight, and people are still spending money. It has also noted that the households' cost of living pressures have increased, so household spending has started to slow down. Still high, but it is slowing down. They've noted here some further tightening of monetary policy may be required to ensure that inflation returns to. Don't be surprised if we see a few more rate rises. We've just seen 13 odd rate rises. They're giving it a pause like they have in the past. They want to see if there are any changes over the next month. And they could very well go back to raising rates. So look, it's good news for now, but we're far from done. If you dive into the RBA, they've actually got a whole bunch of chart packs you can dive into if you're interested. Interesting thing to see here is that, regardless of whether you're following CoreLogic, Residex, APM, or the ABS, there is some pretty consistent data. The Australian property market has had that significant fall. CoreLogic data is showing that we have had an increase over the past 4 months, and I'll show you what that looks like. And here, this housing loan commitments is an interesting one. It's interesting for me because it gives you an indicator of new loan commitments is people going to get loans to buy real estate. The more people that are getting loans, that's a stronger demand. More demand typically leads to higher prices depending on what's going on with supply. But we do know there's low levels of supply. So paying attention to demand is important. What we can see here is that total loan commitments have dipped off a little bit. People are less interested in getting loans, whether they are owner-occupiers, that orange line, or investors. So new loan commitments is starting to dip a bit. People are feeling the pinch, feeling less encouraged to go buy real estate. Okay, let's move along. So the Home Value Index shows housing values have increased in the month of June, but the pace of growth has slowed. So yes, we have seen a 4th month of growth, but that growth rate has slowed a little bit, and that makes sense. There's only so long we can see interest rates keep on increasing before people's sentiment, the consumer sentiment, starts to really hit people's confidence, but also just the cost of debt is high. So people are eventually going to slow down buying new property or buying property in general. Here you can see some of the big winners and losers. New South Wales Capitals is really leading the way, followed by Queensland, South Australia, and Perth. Then obviously we have Victoria behind that and the rest of the states. Okay, let's dive into the next bit of data. So this is interesting here. Short-term selling is on the rise as property profits fall. I think this is pretty interesting. Basically, this report goes on to talk about there is a number of loss-making sales increasing over the March period. number of resales declined 6 point. So basically, a lot of people have gone out, bought property over the past couple of years, and they're the biggest losers. People that bought real estate over the past sort of 24 months, or about 24 months ago, before all these rate rises, bought at the peak of the market, and they bought while interest rates were at 2-3%. They were getting assessed at 5-6%, and now interest rates, if they've come off their fixed rates, have come back, and they're looking at 6.5-7%. So their mortgages have basically doubled, sometimes tripled. So they bought at the height of the market, paid a premium for this real estate. The debt is now costing them 2 to 3 times more than they anticipated, and some of those people are feeling the pinch and starting to sell. So they are obviously making a loss. I want to show you this quick video. Hold on, here we go. So Tom Panos.
Just auctioned the property behind me or above me there. Sold a year ago for $2,250,000 in Mascot in Sydney. Today, with a price guide of $2 million.
So they bought the property a year ago for $2.25 million. They've set a price guide which is 10% below what they bought it for.
There was no takers.
No takers.
Had to go in. I'm letting you know.
So look, there's more of that, Tom. Other agents are talking about this, but there are still, this is isolated incidences, but this is kind of the canary in the mine, where these are early signals that there is some pain in the market. People are struggling, and you've got isolated incidences where people are definitely making a loss, but then there are other incidences where there are certain big premiums being made, and I'll show you where that's happening as well. Okay, so let's dive in. Okay, pain and gain report. This is a really good piece of data which talks about which parts of the market are having the most pain and gain. Now, how units have received getting more pain than houses. Okay. We've got a big report ahead of us, so I won't dive too much into that. Now, as rates rise, times get tough. Property investors opt out of the property market. This is another piece of interesting data that basically goes on to talk about who is selling their properties. So what it's showing you is a portion of listings that are inferred investments from May 2023 versus a previous decade of monthly averages. So over the previous 10-year average, about 25% of people that were selling were investors. Now currently it's about 30%. In Sydney it was 27% over the 10-year average, and it's currently 36.3%. If you run down this line, it's basically saying that people that have been impacted the most and the people that are selling the most currently are people that are investors. They may have had their own home, use the equity from their property, use that market climb to take some equity out, buy an investment property, haven't budgeted for this type of interest rate. And now that times are getting tough, they're saying, listen, I'm going to sell my second, third investment, take the cash off the table, now offset their home loan to reduce the amount of debt that they've got their own house. Now, I get this because I'm actually doing this as well. I've just bought a house. I've got a massive amount of debt, and I'm not selling all of my portfolio, but I'm selling one of my assets in order to offset the offset the debt on my principal place of residence. It just makes life a lot more manageable. It's not the recommendation for everyone, but sometimes you need to unwed yourself from your property. It is just a business decision, and the better decision for the long term would be to hold it. But depending on what the financial pressures are, depending on what the stress levels are in your house, sometimes it's better to live a less stressful lifestyle, have sold some assets, take some cash off the table, and have your rainy day funds available. Having that cash available means that you can then redeploy it into some really good investments now as the market gets a little bit tougher. Here, it's not exactly clear why investors are selling, as individual circumstances would apply for each listing. But I think the circumstance that I just outlined is probably an indication of what's happening out there. Thank you, Eliza Owen. Okay, let's dive into now the monthly chart pack. Okay, here we go. Over the past 3 months, national values have grown by 2.3%. So you got $1 million property. It's grown by $20,000. Not bad. Over the past 3 months. Okay, now not all areas are moving evenly, and this is where that big caveat comes in. Now you can see here the 3-month change has been largely led by Sydney. They're the big winner here, 4.5%. And then even within Sydney, you'll see it's not just all of Sydney growing, because we've seen here that there are isolated incidences where people are actually losing money. It's specific parts that have been growing the best. Let's keep on going down here. Okay, this is one that I really like. I like looking at the quarterly stratified hedonic dwellings index. Basically, CoreLogic have stratified all the sales into the lowest 25 values, middle 50% values, and the highest 25%. So the big market winner in Sydney has been the top 25% of people, the top 25% of property prices. That is, I think, if CoreLogic is watching this, they'll have to double check with me. I think it's above $2.5 million. That's the highest, 25%. So they're leading the way. Then, beneath that, you've got, the middle 50 and then the lowest 25. And that's consistent again with Melbourne. The top part of the market is leading the way. But then it's kind of the inverse in Brisbane, and then again the inverse in Adelaide and in Perth. So affordability is leading the way in the more affordable markets, Perth, Adelaide, and Brisbane. Melbourne, it's the inverse effect, and it's kind of following what's happening in Sydney. Market's growing, but not everywhere. Some parts of Australia are clearly still suffering. Okay, let's look about the housing cycles. No, we'll keep on going. We'll move past all of this. You can dive into the data. This is a monthly chart pack if you're interested. Okay, national sales. This is interesting for me because it talks about what total volumes, how much available stock is on the market. Monthly sales volumes, you can see here that there is a slight uptick, but we're still 25% below the historic, the 5-year average. So CoreLogic estimates about 38,000 sales done in May, 38,800 in May, but the 5-year average should be about 40,000. So we're still trading about 20% lower than the amount of sales we should be doing. So the amount of available stock selling is quite low. This is reason why the market hasn't dropped in values as significantly as people predicted, because it's a supply and demand game, right? Let's keep going down here. Where is supply the tightest? Supply is tightest in Sydney, Melbourne, and Brisbane, and then also some regional markets in Tasmania. Okay, median days on market. This is another really good piece of information for you to look at. It talks about how long it takes for real estate to sell. So if we have a look here, the amount of time it takes to sell a property is trending lower. The median days on market nationally is down to 33 in the 3 months to April. Capital cities are now selling a median of 29 days, down from 33. However, if you compare it to the same time last year, basically May last year, Australia took 24 days to sell the average Australian property. Now it's 34 days. In the combined capitals, it was about 27 days, and now it's 44 days. Combined regionals. In the combined capitals, it was 23, and the combined capitals now, it's 29. So basically, it's taking a lot longer to sell real estate now than it did a year ago, but that time has, over the past 3 months, it's gotten a little bit faster. And the clear data that's pointing here is that the biggest, I guess, not loser, but the time it takes to sell regional properties is a lot more than what it was a year ago, but also a lot more than the combined capital cities. Okay, some vendor discounting. Vendor discounting is basically from what they're offering the property at and then how much it actually sells for. And you can see here that the combined capitals is about 4.1%. So there's a little bit of vendor discounting out there. Total available listings is another interesting one. So new listings over the 4 weeks ending June were about 30,000. Compared to the same time last year, we're 24.4% below compared to the same time last year. And then compared to the 5-year average, it's about 16% lower. So total available listings is total properties that are on the market. There's not a lot of property on the market. 16% lower than what it should be over 5 years. Okay, let's keep on going down. Now you can obviously dive into the data and have a look at what market specifically, in Hobart. You can see here combined regionals in Hobart, it's 46% up. So there's a lot of property available to sell in Hobart. That's why, it's probably not as going pretty poorly. Okay, let's go down. Clearance rates are sitting at the 70%. As we've discussed in the past, 70% is about, an even market. If it gets above 70, that's when you see growth markets. Rental market, interesting data here. You can see that across Australia, the property market rental growth has grown by about 9%. From the 12 months to May. So growth in rents has slowed across the smaller capital cities in regional Australia while remaining strong in the larger capitals. So people are coming back to the capital cities, and this makes sense from a migration point of view. We've got a lot of people coming into the country, and they typically go into Sydney and then Melbourne, and then people out of Sydney and Melbourne then typically go to Brisbane. And that's what we're seeing in the data here. Okay, we'll keep on going down here. This is interesting. Dwelling approvals and housing credit. Dwelling approvals fell to negative 8.1% in April, taking total dwelling approvals to its lowest level since 2012. House approvals in the month were 18% lower, below the decade average, and unit approvals were 52% lower. 52% lower for unit approvals. So this is what I've been talking about. If you have a look at this data, and I'm going to zoom in a little bit, not zoomed in too much, but we're trending lower below our decade average for houses, so brand new housing approvals, and also for apartment approvals. We're at record levels of low levels of stock coming onto the market. Now, what's interesting about this is it's not so relevant for today. It's more relevant for 24 to 36 months from today, because it takes time for those approvals to get done. And then it also takes an additional 12 to 24 months for the properties to then complete, depending on whether it's a house, townhouse project, or large-scale apartments. So this is an early indicator of what we can look at or expect in 24 to 36 months from now. Now, what that's telling us is that we've got low levels of stock. Okay, new housing finance secured. You can see here posting for the month fell by about 3%, which is what we saw in the RBA data. The largest monthly fall in housing finance was across the owner-occupier and non-first home buyer segments, followed by a 2.1% drop in first home buyer borrowing. So, and then also a decline in investor segments. So basically everyone's saying we're slowing down on finance commitments. We're not that interested in getting a loan to buy some property at the moment. I'll keep on going down. Housing credit. Through the month of April, average new variable rates were fairly steady for owner-occupiers at 5.4%, following a increase, and then the new investor variable rates are averaging at about 5.7%. Okay, there's a lot more data in here. That's the end of the chart pack. Okay, so what is my big read after going through all of that? I'll spare you a big ramble. Team, it looks like there is low levels of available stock coming onto the market, And it looks like there are a number of isolated incidences where there's pressure in the market as well. So there are going to be more forced sales you're going to see. And it looks like we're going to see more forced sales, particularly from investors. People that have got that second property, they're more likely to sell their investment property than their own home. Everyone has that emotional attachment to their own home. So they're going to clear some debt, sell the investment property, take it off the market, take the available cash, if there is any available cash, because we saw that some people are losing money, and then offset their own home. What's my read in all of this? I think that over the next 3 to 6 months, you should definitely be, if you're interested in real estate, you should definitely get your powder dry, get your money ready to strike on a deal, but don't try and time the market. Don't try and wait for the ideal time to buy a property. Get very clear on what you want to buy. Get clear on what your strategy is, because I think there are going to be some good deals out there. And I also think that now is also a good time to get out there and buy an investment. So if you have the ability, if you have the spare cash, you've got the servicing, you feel quite comfortable, now's a good time to go and get that second property, because I can see some short to medium term growth in the property market just generally because of the low levels of supply that are coming on. And as I've said in previous podcasts, there's hundreds of thousands of migrants coming into our country. They all need a place to live. We're seeing high levels of inflation from housing costs, and that's because of rent. Rents are increasing. So from a short to medium term play, I think that those that are, carefully measured in what they're going to do next, have done their budgeting, will definitely benefit from going and buying a property. But you've got to be careful. You've got to do your budgeting. Talk to your mortgage broker. This isn't financial advice. Go and talk to your accountant, see what you can afford. I also think there's going to be some pain in the market. And I still see that the strong markets, the strong markets with the capital cities is where we're going to see a lot of that growth. And it's just a simple supply and demand game. So get out there, look for good pieces of real estate, stay next to major metro cities, do your budgeting, look for strong income growth, because there's more rent rises to come. And now's the time to be out there looking for those deals. Happy investing, happy house hunting. And if you've got any questions, let me know. I look forward to seeing them in the comments.